Hi, everybody. It's Mike Martin from Martin Chronicle and the author of The Inner Voice of Trading. Today, my guest is the inimitable Jack Schwager. Jack, thanks for being here today, buddy.
Hey, glad to do this again. Thanks.
My first question is why are manager returns alone not enough for the average investor to use in making an investment decision?
Because manager returns are very poor. Oh, let's back up. Past manager returns are a very poor indicator of future manager returns. And we like to believe otherwise, but I've looked at these figures and statistics many times, many ways. But the unfortunate reality is that if you pick the managers who were best in the past, it has a very, very poor predictive power for the managers that will perform best in the future.
So that tags in nicely with the concept of past performance is not indicative of future results.
Yeah, but that is like some like disclaimers. Well, some disclaimers are needed and true, but many times disclaimers, people disclaim everything just because they're legally required to do it. But everybody reads and says, "Oh yeah, they got to say that." But in this case, it really is true. So it's people will read that and think, "Oh well, they got to say that," but not really absorb the fact that this is not a statement of reality. They see it as a statement of legality. But I guess what I'm saying is it's actually a statement of reality.
As human beings, though, you, Ed Secoda, Mike Marcus, myself, any retail investor, our brains are built to respond to opportunity. And those opportunities could come as being emotional or intellectual, and sometimes both. So, what's the average investor to do?
Well, the easy thing is to, well, there's the old cliche about generals fight the last war, and investors and invest in the last hero or in the last good market or whatever. And I guess one of the themes in his book is that's a very bad approach. And in some ways, and I explain why, in some ways you're sometimes best off in picking the worst rather than the best under the correct circumstances. And what I guess investors have to do is to just become aware of it. I mean, my point on this is that investors don't even realize this. They go by the ratings, and the ratings are based on who did best in the past, and they may not understand that who did the best in the past is often a function of what market sector was hot in the past. And there's good reason to believe, because markets go in cycles and because things get overbought and oversold, that what was good in the past may be worse in the future. And that's part of the explanation of why people go wrong by picking the highest ratings, because the highest rating managers are often are not the highest rated because they're the smartest or the best or the most skilled. They often happen to just be in the right, specialize in the right sector. And that's why they're top rated. So if you were to take a situation where, let's say, energy markets were really, really doing very well, energy prices were going way up. Well, who's going to have the best records among managers, let's say long-only managers? It's going to be the guys who are specialized in energy. So it's not because they were brilliant, it's just because energy was going up. Well, now if you go by which were the hottest managers, the hottest funds in the past period, you're effectively picking, in that example, you'll be picking up a lot of energy funds because that's who the best. But does that mean that energy funds are likely to go, or those managers are more likely to do better in the future? No. On the contrary, because if energy prices are going up enough, they're probably overdone and more likely to come down. And that's why people who do that find out not only don't they get better performance, but they often might do considerably worse than average.
Let's talk about market timing. John Bogle would say just buy the S&P 500 whenever and own it for whatever. Your research suggests otherwise. Explain that.
Yeah, so there's so many things. I guess at the heart of it is everything that people do, not everything, but most things people do in investing tend to be wrong because they're led by natural human emotions. And so when you get a period where stocks have been going up and your neighbor's telling you, about how much money he's making in the stock market, and your brother-in-law is telling you the same thing and so forth. And if you're not invested, you sort of later you get, and you look at it, yeah, this is going to go, and things are hot and the economy is good. And boy, you finally get involved in the market. But those are like the worst times to get to invest. And I did a study in this, and I kind of knew that, but I wanted to kind of just do an impartial study. So I got stock prices back to the 1850s, I believe, or something like that. And I looked at the exercise of going back. If you looked at the best, how did the market do in the last 5 years, last 10 years, last 15, last 20? And then looked what it did in the next 5, next 10, next 15, next 20. And I looked at two circumstances. You pick those periods where you had really bad past periods, like, the market during the last 10, 20 years was in the lowest quartile of all years versus the highest quartile. And I compared the two, and invariably, in just about every single case, every single period, any combination of past and forward, you always came up with the same answer. If you bought the market after one of these periods where it had been like particularly low performing in the past period, that was a good time to invest. Much better than just the opposite was true when you invested in the market after it had done really well. And so the idea is you really want to invest when it seems like a horrible idea. When people are saying, I can't stand this anymore, and they're cashing in as I never want to see a stock again. That's when you want to invest. And you don't have to kind of even gauge that emotionally or try to gauge where the market of sentiment is. All you need to do is look back on how the market did in the last 10 or 20 years. And if it's a particularly poor performing relative to the historical average, then that's a good time to invest. If it's particularly good, then it's not a good time to invest.
Every finance class in America starts with the efficient market hypothesis. Those folks eventually become investors, or they end up going to Wall Street and they say you just have to buy and hold, you can't time the market. So where and what and why and how are we going to be able to break that cycle and take your research from this book and kind of change the thinking?
It's first acknowledging that the model is wrong. Now, efficient market hypothesis has been sort of the academic, it's changing, but it's sort of the academic Bible in a way. And I believe because it made things easy. It's like because if you assume the efficient market hypothesis, then you can make mathematical judgments about how to allocate, what is the optimal portfolio. You can make all sorts of what probabilities are of certain things happening. Everything kind of can be quantified. But the underlying assumption is totally wrong. It's sort of like the old joke about the drunk looking for his car keys in the parking lot that he dropped, and the car keys that he dropped in the parking lot, and he looks under the lamppost, not because he believes he lost them there, because that's the only place where there's light. And that's kind of what the EMH people are doing. They're using a theory not because it's correct, because the math works out well that way. But the efficient market hypothesis, and it's one of the things I do in the book, is I think wrong on so many levels. And it's almost like, well, I don't know where to begin in a simple answer. Because in the book, I probably give like 18 ways it's wrong. But one of the most fundamental ways it's wrong is because it assumes that markets are only affected by fundamentals. And it leaves out one very, very important ingredient, and that is human emotion. And the reality is, so it comes to the conclusion, if everybody knows all the information, everything's discounted, prices are right. Well, that's nonsense, because prices are not always right. Anybody who has ever been involved in markets knows that price is not always right. I mean, look at something like internet stocks. And I use that as one of the many examples in the book. But internet stocks back in 1998, mid-1998, up to 2000, 18 months, up 600%. Then the next 18 months, down the whole way. So, you have this six-fold increase in prices, and then all the way back, all in a 3-year period, up and down. Now, to really believe in the efficient market hypothesis, you would have to believe that all this, immense amount of bullish news was coming in all that period of time, and then in 2000, a tremendous amount of negative news. Whereas in reality, nothing happened. Nothing happened. Internet companies were internet was growing all along, and internet companies were, these companies that never made, the companies went out of business, never made any money to begin with. It wasn't that any news was coming in and all this positive news and all the negative news. What was really happening is you were getting this emotional frenzy, and suddenly somebody's the last one standing without a chair to sit in, when the music's over, and boom, it goes all the way back down again. So it was a matter of human hysteria taking it way too far, and then reality setting in and went all the way back. That's all that happened. So by missing the human emotion part of it, efficient market hypothesis, gets this complete distortion of what really happened. And that's just like one example. There's lots of them.
Well, what about the madness of the crowd, so to speak?
And I guess there's one other thing, Mike, before we leave that is there's so many mistakes, but another one I think is really important to understand is that the EMH academics and the traditional investment world that assumes that, they say, well, everybody has the same information, right? And the information is instantly discounted, so you can't get ahead. And that's so wrong, because just because everybody has the same information doesn't mean everybody uses it the same way. It's like the analogy I use is if you have a chess tournament, everybody knows all this, how to move the pieces. Everybody read the same chess books. If having the same information, then everybody should be playing to a draw. But in reality, I mean, you have masters who crush their opponents, not because they have more information, but they are more skilled in using that information. And in the market, some people are more skilled in using that information, or are more talented in using it, however you want to phrase that.
So, Jack, investors really need to not only know the technical side of investing, fundamental technical analysis, they also have to have a strong sense of their own emotional constitution and, as I like to call it, a stronger inner voice.
Well, yeah, I mean, the point was it's both. It's emotional constitution and being able to act independently and not be swayed by the crowd and so forth. So all of those things, sure, they're important, but also the skill with which you analyze the market, which could be any approach, could be technical, fundamental, or a hybrid of the two. What I'm saying is both are true. Is that the market price is not necessarily correct. Because people may not be interpreting what's important as being most important, even though everybody has all the same information, and the individual can be better than the market as a whole in interpreting what the information out there is. Plus, of course, different individuals may have better emotional constitutions, or emotional constitutions that are better fit to trading the market. So both are true.
I can't remember if you told me over the phone or if I read it in Market Wizards, but Michael Marcus said that, if you try to blend two different investing styles, you get the worst of both.
Both styles. Yeah, that is from Market Wizards. And I think the exact or close quote of that is you have to follow your own light. But it's very much correct that his point was that he said, even if you take two great traders, you'll end up with the worst of both styles,
Pro forma returns are just as bad as average returns, because they can be very, very misleading. What's your take on that?
Well, pro forma is one of those words that kind of is used in two different contexts, and it can actually be that are opposite. It's sort of like I didn't use this in the book, but it's sort of like a word cleave. Cleave is one of those words which means both to join together and to pull apart. It's very ironic. The same word means exact opposite. And pro forma is like that too, because I'll give you two examples. Like pro forma is often used in the context you don't have the actual for some reason, and you do these statistics that are proxy for the actual. So, for example, if you have a new fund of managed account, a new fund of funds beginning, right? So the fund manager picks these funds, and it's a new fund of funds, so there's no track record. It'll say, I got 20 investments, and I'm giving equal money to each, and here are my 20 investments. And if you invested 5 years ago, here's the actual track records, and this is what the track record looks like. And yes, that's a pro forma record. And yes, it's based on all actual track records. And so investors can be beguiled and think, okay, yeah, this is based on actual. Well, yeah, But the point is, I, as the fund manager, I'm not going to go and pick 20 guys who did poorly. I'm only going to be picking from guys who did well. So by definition, I've got that hindsight, and therefore, so even though the track records are real, you're getting a very, as a statisticians would call it, a very, very biased sample. I wouldn't have had the foresight to pick those managers 5 years ago. By hindsight, I'm picking them now. So in that sense, that use of pro forma is enormously misleading. On the other hand, you have the opposite situation where, let's say I'm a trader and I'm managing my own account. I'm doing really, really well. And they say, you know what? I can also be managing other people's money, and I could might as well do that as well. So I open up a new fund and I use my own actual account the last 5 years. But I say, look, I wasn't charging myself any fees. I'm charging investors 20% incentive and 1% management. So I'm going to adjust all my past numbers by those fees. Now, in that case, ironically, the pro forma is actually more representative and accurate than the actual, because the investors are paying the fees and I didn't. So that use of pro forma makes the results more representative. So it's kind of, that's why I'm saying pro forma is one of those words that's like its own opposite, depending on which context is used. And investors need to understand that sometimes pro forma results are meaningless, and you got to be aware of that. And sometimes they can be very, very, they can be quite meaningful, but you have to know the context.
So Jack, if you're dealing with like a financial planner or an investment advisor, financial consultant, they say past performance is not indicative of future results, but I think the proposals that they make are even worse because they cherry pick out all the companies that blew up and all the managers that failed. So when they go in and they take your age, your years till retirement, your liquidity, your number of dependents, and they come up with this asset allocation and then the recommended investments, they don't allow themselves the chance to have blown up. It almost makes their picks clairvoyant on some level because they are not able to pick up the Enrons or the companies that went bust. So the results are going to be very, very skewed because of the survivorship bias.
Well, I mean, this goes to the question of portfolio optimization. And it's one of those things that the math of portfolio optimization is perfectly sound, obviously. I mean, it is. And in fact, you can define precisely what mix of investments you should have had to maximize return to risk or any other preferences for the past. You could do that very precisely. There's just one problem. You're investing for the future instead of for the past. If we can invest in the past, that would be the right solution. But now, if you're investing in the future, the relevant question, which no one seems to ask, is there a reason to believe that the past returns are representative of the probable future returns? And so what I think is probably a classic example, which happened to exist at the time I was writing the book, which still obviously exists, is the bond market, for example. So, if you go and you use your portfolio optimization now, and you have your standard mix of stocks and bonds, and maybe you'll have some alternatives, but let's say, keep it simple and say it's just stocks and bonds. Regardless, no matter what you have in there, it's going to say bonds are a great investment. Because why? Because from 1980, we've seen interest rates come down, which means bond prices have gone up. So you have literally a 30-year bull market in bonds. So the mathematical model doesn't know anything. I mean, it just knows what you're giving it. You're giving it these returns. For all it knows, the built-in assumption is that the next 30 years, or it's using the past 30-year period as the assumption for the next 30 years. But now bond prices came down from 15% to 3%. Now, if you believe that we can go from 3% to minus 12, great. That's the model you should use. If you think it's unlikely we're going to go to minus 12% bond prices, then the very fact that we've come down so much is not only not constructive, it's actually a negative. The fact that the market has done so well in the past means it's very unlikely, it's actually impossible for it to do anything similar, but moreover, it has almost no room to go on the downside. And if anything, it's more likely to go up. And then if you couple that with the fact that there's large deficits and you have all sorts of long-term arguments why prices may go up from where they are, and therefore inflation might pick up from very low levels. You have lots of reasons why the reverse might be true. So the question you have to ask yourself, are the past return levels relevant? And often they're not. And if they're not, then the whole idea behind portfolio optimization falls apart. But people like a precise answer, so they like to use those models. The same reason why they will go to Morningstar and pick the 5-star funds. They want the precise answer. But the question is, are those past statistics relevant to the future? And my point is, they often aren't.
So, Jack, it doesn't seem that institutional investors have an easier time picking managers than retail investors do trying to pick stocks that won't blow up. True or false?
Yeah, and then that comes into various, that comes in various forms and various times that you have to, if you're basing your assumptions on, if you're doing tests based on past data, which doesn't include the investments that have gone out of, that have gone bankrupt, or if it's companies or managers that have gone out of business, if it's managers or whatever, you're going to get a very distorted. And it comes up a couple of times. The concept comes up a couple of times in the book. But for one example, I deal with the paradox of fund of funds underperforming single hedge fund managers. So it seems like kind of an odd thing. You have these professional managers, allocators, whose only job is to pick the better than average managers and put them in a portfolio. And yet, if you look at fund-to-fund statistics, their returns are consistently worse than if you look at indexes based on the managers themselves, which seems to imply that the fund-to-fund managers do, worse than just throwing darts. But, that's actually not what's happening. What's happening is that the indexes based on single managers have all sorts of biases, and survivorship is only one of many, many biases, and not necessarily even the biggest one, where those biases don't exist for the fund to funds level. So if a database you were using didn't include funds that went out of business, right? But if I am an allocator and I've got a fund of funds and I give it to a manager and he blows up and he goes out of business, his returns, if I gave him money, his returns stay in my record. That's like an example of why fund of funds data looks worse, because it can't hide a lot of the biases that occur in single hedge funds. So it's just an example of how you get misleading.
Last question. Let's talk about what you call Robinhood investing. Trend following would say that you cut your losers and you actually reinvest in the winners. You're saying with Robinhood investing, that you actually take from those winners and you reallocate over time to the ones that hadn't worked out. Explain what you mean by that.
Right. Yeah, it's the idea that, and the assumption here is that you have, a simplifying assumption is that you have multiple investments or multiple managers, and you think they're all about, for the future, sure, you can say who did best in the past, but going forward, you have no reason to believe that one is going to do better than the other. And so let's say you get a period where one is, where some are doing better and others are doing worse, but you still believe they have equal chance. My point is that when you rebalance the portfolio, what you're basically doing is you're putting everybody back to the same allocation that you had originally. And so effectively, that would mean that you're taking money away from the ones who've made the most money and giving it to those who've done most poorly. And that seems like just a frightening idea to some people, and like an horrendous idea. How could you, as one boss I once had when I was advising on how to allocate, do these things, doing research on it, said, "You mean take from the winners and give to the losers?" Like I was extolling the virtues of murder or something like that. And I said, "No." I said, "You're missing the point. We're taking from one winner, giving it to the other winner. It's just that they're winning and losing at different times." I did the study a number of times, and actually, talking about survivorship bias. When I did it in a book a number of years ago, I actually committed survivorship bias because I used a database and I did the study, and it came out the balancing worked quite well. But I realized that I used a database that didn't include funds that had gone out of business. So this time, and give them credit here, Stark Research, I used their database, and they've got a database that includes all these funds that went out of business. So I randomly selected from all funds. It could have been a fund that went out of business fund, and I still got the same results fairly decisively. So it's the idea that rebalancing tends to work, basically.
Jack, thanks for your time. I appreciate your insight. It's a great book. Jack Schwager, Market Sense and Nonsense. Go check out the book right now, and I think you'll really like it. Take care.
Okay, thanks, Mike. Take care.